Welcome to the M&A Healthcare Insights podcast. I'm your host and partner at M&A Healthcare Advisors, Andre Ulloa. Today, I am pleased to be joined by Aaron Cook and Jeff Michelson from CohnReznick, who we've worked with in the past and who have a storied, sort of legendary relationship with the market in terms of what they've done for our clients and for buy-side representatives in the past. I'll let them talk about themselves, but with that, gentlemen, welcome.
Thanks, Andre. Appreciate you having us today. Looking forward to this discussion.
Thank you, Andre. Well,
yeah, thank you. Jeff, why don't you just give us a quick overview? I am genuine about my laudatory words about you and about the firm. It seems like every time you're on the scene in one of our transactions, it goes well just because, as you know, transparency and removing as much uncertainty as possible is the key to getting these things to close. So in that respect, can you just give me a little background on you and the firm, and then love to get into some questions.
Sure. I'll do a quick introduction, and Aaron, please follow me as well with an introduction on your end. But my name is Jeff Michelson. I'm partner in the transaction advisory services practice with CohnReznick. We're a top 15 firm, depending on which accounting firm has merged with which other accounting firm. But we're a $1 billion firm at this point. We have about 5,000 folks across the country, 350 plus partners, scattered around 30 offices across the United States. We, full audit, tax, and advisory service firm. We're within the advisory portion of CohnReznick. We have about 75, 80 folks here in the U.S. and additional folks over in India that just do financial diligence full-time for a living. So we do buy-side and sell-side financial, tax, HR, IT, and other diligence streams that we can get into at a later point.
hello, everyone. My name is Aaron Cook, and I'm a director in CohnReznick's healthcare transaction advisory practice. I'm a licensed CPA with over 10 years of professional service experience. I've been focused on the healthcare industry for the last 5+ years, focusing on buy and sell side transactions. I provide financial due diligence services, including quality of earnings, quality of revenue analyses, analysis of provider comp to clients within all subsectors of healthcare, including home health, DME, healthcare systems, behavioral health, and other industries as well.
That's great. Well, we wanted to have this conversation because you are such an integral piece of the process, but where you get involved in a mergers and acquisitions transaction for a client is at different times than where we get involved. How do you get involved, and when do you get involved? What's your preference when you get involved in these in the work that you do with clients or with buy side counterparties?
Yeah, it's a great question. Every situation's a little bit different. On the buy side, we're generally in when our client, which is usually a private equity, independent sponsor, a family office, or a strategic client, has signed an LOI with a target. Usually it's, somewhere between 30 to 90 days of exclusivity they have to conduct their due diligence. And so they'll bring in an accounting firm like ourselves to essentially review the historical trends of the business from an EBITDA and working capital perspective, because that's what their valuation and purchase price is going to be based off of. So typically on the buy side, it's usually when there's a letter of intent signed and executed and everyone's on the same page and our client is exclusive. There are some times where it's a process, and so there are multiple parties that are involved. That's a rarity, but it does happen. So sometimes our work is phased out a little bit pre-letter of intent, but generally I'd say the vast majority of our work is post LOI being executed. On the sell side, it's different. So on the sell side, we work with brokers and investment bankers when they are working with a business that what they want to bring to market. And so they'll bring an accounting firm like ourselves in to do a quality of earnings analysis or financial diligence analyses prior to the business going to market. That can be anywhere from, 2 months before they want to go to market to 2 weeks. It really just depends on, how the process has kind of unfolded. Again, I would say the vast majority of the time we're being brought in, I would say within a month of when, the bank wants to bring the company out to market. And so they bring us in to prepare a financial diligence analysis within that, 4-week period, so they can include, adjusted EBITDA and adjusted working capital results within their marketing materials. What I always say, Andre and Aaron, I'd love your view on this, is, I think for any business that's out there, before you even start thinking about an M&A event or a capital raise event, or even before you have a bank involved, in theory, it's helpful to have your books presented and your historical financials presented in a way that's what I call investor friendly. So those, that really means having your EBITDA, your earnings before interest, tax, depreciation, amortization results on a fully adjusted basis. Same thing with working capital on your balance sheet. Because at the end of the day, it can only be helpful for any process, wherever you are in the process, to have your financials in a way that investors are going to be able to understand and react to. So my recommendation for when we talk with businesses is, even if you're a year or two out, start thinking about getting your financials, whether you're audited or not, in a way that investors will be able to understand and appreciate.
Yeah, and I'll echo what Jeff said. We work with a lot of in our healthcare practice. We work with a lot of unsophisticated clients, from family-owned businesses to owner-operators and to founders. We see a lot of, I'll call it, mom and pop shops that have grown to a level where they're looking for outside capital to grow their business. And a lot of times we'll step into the business that's often run on a cash basis and help them understand, the benefits of presenting accrual-based financials. And oftentimes accrual-based financials are mandatory in a transaction setting. So, to Jeff's point, we like to come in as soon as we can in the process, get engaged with the operators, understand, what drives the business and how we can best position our financial due diligence analysis.
Why does a sell side, and just so our audience understands, when I refer to someone on the sell side, I'm really looking at someone who's, in our category, founder, usually founder, owner, lower middle market, meaning, on the sort of lower end of the size. These are, that we represent, they're all healthcare businesses. You're agnostic, and I know that your group has a good focus on healthcare, but can you talk to why a sell side client would want to bring on a firm like yours and do this type of accounting, this level, what we would call sort of a quality of earnings level accounting, pre-market, pre-deal?
Yeah, I'll take that, Aaron. We'd love to get your thoughts too. Andre, the way I always equate is, if you're selling your house, right, and the buyer's going to come in, do a home inspection, try to ding you for a leaky roof or something in the basement that's fallen apart, so they can reduce the purchase price. It's similar to that sort of process, but obviously you're selling your business and not your house. But in the home sale scenario, we're essentially the inspectors, right, and the brokers or the bank are the real estate agents. So we come in. And from a financial and in theory, a tax and operational perspective, we look at the business historically in terms of what the business has generated from a revenue and earnings perspective. And we identify things that a buyer may identify during their diligence process, whether it's positive or negative to your earnings or positive or negative to working capital. But it really, from our experience, there are a few benefits. It really helps shorten the overall process, right? It says to buyer, here, we've done this work on our end. We prepared this packet or data book or report. We're handing it to you, and we want you to be done with your diligence in 3 to 4 weeks because we've already done the work. So that's one benefit. The other benefit is it gives confidence around the numbers that someone's gone through. They've vetted the historical financials. They've identified adjustments to those financials that, again, a buyer is going to want to understand. And in theory, a buyer comes in and says, all right, yeah, you've done the work, and they're gonna pick it apart and try to, find things they disagree with or try to find additional things that need to be adjusted. But, vast majority of the time you hand someone a quality of earnings analysis and, the EBITDA is not going to move significantly. That's our job, is to identify those positive and negative movements. But it also helps identify potential things that, a buyer might come and say, we're going to ding you for it, or there's a red flag, or there's a liability sitting out there that a buyer is going to identify and try to, in theory, reduce purchase price. And it gives, as a seller of a business, it gives you the opportunity to work with the accounting firm, work with your bankers or your brokers and say, okay, now what do we do? How do we present this in the best light, given that, it's been uncovered and we know that someone coming in is going to uncover it? What do we do? So, it gives confidence to numbers, but it also lets you as a seller identify things that, a buyer is going to flag, and gives you a chance to essentially react to it.
I love that you talk about shortening time frames, and then you talk about confidence, right? And both are sort of interweaved in many ways, but the idea of the time frame, I think, is surprising to a lot of our clients who have never been through an M&A before. And what they need to understand is that as much as we can prepare on the front end, that's how much time we're going to be able to shave off of this, post LOI, and as we go into the back end. I mean, when we talk about LOIs and how we negotiate those, we definitely get into a lot of the details on the definitive agreement, and so there's some commercial stuff in there, but there's a lot of legal in there. From an accounting standpoint, it's the financials are the backbone, right, of who we represent. And if we can go in and know that what the numbers are, and we can present those within the materials, then not only are you going to get a counterparty that's going to say, well, they might even be more likely to do the deal because of the quality of the information they're getting, right? Whereas somebody that looks at information that isn't up to a certain standard, and as Aaron mentioned, like, we deal with a lot of clients who are operating on cash basis, who do not have books and records that are in any kind of order. And if you can turn that around and present the buyer with information that's polished and that you can feel confident in, I'll just say it's really worth its weight in gold in terms of what it means for the value of the business and what it means for the success of the process. So can you speak to sort of what you see in the market? Because we definitely have a lot of resistance from our clients on the front end to saying, like, why do we need to do all this work, and what's the reason for this? Do you have a sort of response for them in terms of how long that kind of takes, and what some of the benefits are of it from a financial perspective?
Yeah, I mean, we get that all the time. Look, we understand the cost, and there is a cost to doing quality of earnings analysis. We bring in, and Aaron is, a director in our practice. All of our senior folks are experienced. They know M&A. They do M&A 100% of the time. But the reality, again, is, look, I go back to selling your house. If the foundation of your house is not strong, in any situation, I've sold a house where I had issues with my foundation, and it caused an issue with the sale process. Here, if your financial foundation is not strong or not based on reality, any M&A process is going to fail right off the bat. So, having someone that does this full time come in, even if you're audited, even if you're reviewed, it can only help the process, because, again, it allows for us to identify things that someone on the other side is going to flag as a potential issue for a deal, and we want to address that up front. So, for a seller of a business, if you're audited and auditors come in and give you a clean opinion, we take a different view of things. We go back historically and we adjust for things that are theoretically additive to EBITDA. And when you're dealing with multiples on EBITDA, even if we find an adjustment that's $100,000, that could be $1 million of additional purchase price. So, for an audit, they're not going to be at that level. So we look to come in, we're a very bottoms up approached process where we go into the weeds. Aaron and his teams that does this all the time. They're in the weeds. They're looking at trial balance accounts and general ledger detail, trying to pick out things that in theory will be additive to EBITDA. So that's what we do full time. And yes, it's time and money, and yes, there is again a cost to it. But if we're not earning our fee multiple times over through this process, we've probably done something wrong. Not that to say that every process we go through is only accretive to EBITDA. It's not, because there are times where we come in and there are things that we identify that reduce EBITDA. But again, at the end of the day, as a seller, you want to know that up front before you go through a buy-side process, because that'll kill the deal automatically. So Aaron, I don't know if you have any other thoughts there.
Yeah, I guess going back to the fee conversation, our work isn't performed for free, so there is a fee associated with any sell-side work. And oftentimes the question comes up in a transaction, who's responsible for paying the fee? And really, it is the sellers. But what we have to articulate to the sellers that, to Jeff's point, we will provide value and will help pay for our fee during the process. And as Jeff alluded to, due diligence is a very detailed process. Oftentimes, the family operated companies, founders, they're not familiar with a process. We get into our first kickoff call with them. They think it's going to be a 1 week exercise, but really it's not a 1 week exercise. And the timeline on the front, when we're working with the sellers, can often be extended. We often want to stay, in bounds of the timeline that's set up by the client and the investment bank. However, we do have the opportunity to spend a little more time on the front end to reduce time on the back end. Some of the other, analyses that we do is convert, as I mentioned before, converting the cash basis financials to accrual basis in a healthcare specific transaction. For any company that has a fee for service revenue component, we'll assess the quality of revenue. We'll perform a historical cash look back analysis. There's billing, coding, and compliance reviews that we do. We get intimate with provider compensation and look at trends over time as part of our process. And just to be clear, due diligence is different than an audit. When you think of an audit, it's typically required for compliance purposes, where due diligence, it's a wider scope and it's determined based on what is relevant for the particular transaction and what's important to the company that's about to transact. So hiring a third-party advisor on the front end will help just get organized on the front end as we conduct our detailed meetings and understand the business.
Well said. We find that there's definitely a distinction between sort of your standard accounting analysis and transactional analysis. That's a big distinction for us. And what we think about more on the transactional side is what's relevant. It's the realities of the situation, and we get into that again with conceptually on the legal side, but commercially the foundation of this transactional analysis is the work that you do when you assess these companies. And and I think that as you talk about foundations and what you want to go into a deal with, that's it. Because what one questions I had was around what counterparties are looking at when when they're looking for analysis from the sellers. And as much as you mentioned the word accretive, right, Jeff? We talk about our accretive value to a deal as M&A advisors or as the quality of earnings analysts, but there is this concept that sellers have that their business has value beyond the numbers, and I think that exists. That is true. There are assets and there are quantifiable aspects to the business that have value outside of the numbers, but buyers are going to focus at the end of the day. The foundation for their valuation, for their multiple, is going to come from the business and what the business generates in terms of cash flow, and having true adjustments to that cash flow that we can stand behind and that they can prove out. I just haven't had a transaction yet where someone can come in. Now you can do pro forma analysis, but maybe your experience is different, but I haven't had a transaction yet where the company is break even or at a loss, and the buyer will go through it because there's something there in the business that's tangible that they're valuing, right? The business is what it's worth in terms of the numbers, and that's our experience. That's why it's so valuable to have you come in that regard.
Yeah, I mean, look, the vast majority of time, anyone selling the business, the valuation of the business is going to be based on EBITDA or some concept of EBITDA. Some businesses are based on EBITDA, which includes rent expense. But there are some technology businesses, for example, healthcare technology businesses, where they are break even because they spent millions and millions of dollars on developing software costs or developing a software tool. So even though they are break even, a buyer will come in and say, we understand that, but we want the value of that technology and the recurring revenue. So we focus on EBITDA 95% of the time. There are situations where we just focus on revenue, recurring revenue. Again, that would be more like a healthcare technology business where, again, to Andre's point, they are break even or not making a ton of positive cash flows. And that's okay. Our scope and our focus of our analysis is on the sell side is generally guided by the banking and broker friends that we have. And they tell us, here's the focus, EBITDA, revenue, and we focus our procedures there. But yeah, EBITDA is supposed to be a proxy for cash flow. So that's why we focus that. And that's why most transactions are based on some multiple of EBITDA.
Yeah, and I should definitely couch that by saying that the clients that we represent are mature. They're definitely in the category of profitability. They're probably at their life cycle where they've really stabilized and plateaued. A lot of the reason that we get involved is there's retirements or there's a exit. It's usually full exits. And so the kind of analysis that's done by counterparties it's essential that you have this quality financial analysis done because the counterparties are looking into our companies as bolt-ons or add-ons, and there's been a lot of, as private equity activity. Definitely, I would say that the majority of the deals we did in the mid-teens were asset purchases, and they were strategic buyers. But then we went on this run, and there was a lot of consolidation being done by private equity groups. And I think that at that point, the analysis that we were doing on the sell side just wasn't adequate enough for what the kind of work that they were doing on the buy side. I think the levels that they were coming down in terms of EBITDA were lower. They were willing to bolt on businesses that were significantly smaller than the LBO type deals we'd seen before. And so that analysis that you're doing is I think, essential as it relates to private equity groups. And so, maybe you can speak a little bit to the evolution too of a sort of quality of earnings and where, it looks like from our perspective, it's definitely here to stay. We haven't seen less analysis done on the buy side. And are there elements of the sell side analysis that you do that you've had to ratchet up that have gotten even more intense in recent years? Or it's sort of a general question just about the evolution of the work that you've done for lower middle market clients.
Yeah, and we've seen the work change based off of what the seller wants to do. So when we first dive into the process, we want to understand what the goal of the transaction is. And Andre, to your point, as we've worked with more private equity companies on the other side of the table, they want our detailed data book to help feed their model. To your point earlier, oftentimes these assets that are being sold, the buyer is looking for a particular niche of that business to help expand a service that they currently offer, to gain a skill set or to obtain a license, and they want to be able to take the financials of the target company and slide them into their model and continue projecting the future with this asset involved. But we've seen our QofEs kind of evolve over time, being more detailed in the sense of, not just looking at, one-time non-operational ad bucks, but getting more sophisticated and looking at, contracts with providers, looking at contracts with payers, and looking at changes in reimbursement rates. A lot of it will dovetail off of the quality of revenue analysis, where if there's some commercial contracts in play and there's been some rate increases over the time, we'll want to work with our client to be able to quantify what a potential pro forma benefit would have been if those rates would have been in place. And now, we've seen a focus more so on the volume of adjustments. People are understanding, like, hey, here are your adjustments in the quality of earnings table. Can any of these be considered recurring, non-recurring adjustments if that concept makes sense? So we've just done some more work to support our conclusions, looking at the adjusted results of the company, which is effectively the reported results plus the impacts of our QofE adjustments, and making sure that we can explain trends to the other side.
The only thing I'll add there, and this is more on the buy side rather than the sell side, is, I'd say over the past year, as M&A activity has slowed down, there's been more of a focus on synergies. We brought in a pretty large performance improvement team last year, and they've been very busy, because I think as M&A activity slowed down, a lot of our clients focused, on their platform businesses on improving margins, and so getting our performance improvement team in to look at potential cost reductions or pricing increases, whatever the case may be. That was last year, and now a lot of that's flowing through on the sell side, where a lot of these businesses we're looking at implemented some of these synergies within the past 12 to 18 months, kind of post-COVID. And we're dealing with kind of normalizing some of that throughout our period and addressing that through, what we call a pro forma concept, which are, things that might be coming down the pike in terms of synergies or EBITDA improvements that haven't actually been implemented yet, but we still reflect them within our analysis as a pro forma concept. So I think that, to add to what Aaron said, that's the one thing I think we're seeing a bit more of over the past 12 to 18 months.
Yeah, it's very bespoke analysis about the business that you're representing, what the counterparties need to know, and also what can be done to improve and sort of look at the run rate of these businesses, so that we're attaching value to the future of this business and where it's heading. And look, for us, it's primarily services businesses. So a lot of the synergies are within the personnel, and and either management teams or the rank and file, SG&A people that they're bringing in, or so there's definitely synergies in contracts. There's with the work that we do, there's licensure, and there's heavy compliance where a buyer might be able to come in and turnkey based on where that business is. And so there's definitely those types of value points, and you identify those in your analysis, correct?
Yeah, absolutely. And we want to highlight what could be impactful for a transaction, what someone could be looking for. And we need to work with the management who knows the business very well, from the beginning. And they'll help highlight those concepts, and those concepts are identified through our Q&A process that we have with management. I mean, going back to a point I said earlier about how detailed the due diligence process is. I mean, it's extremely detailed, Andre. We've worked together before, and you've seen kind of the level of detail we dive into to ask questions, to understand what's moving the business. And in our reports, we'll highlight some of the key information. It may not have a direct impact on our quality of earnings table, but it might be beneficial for the other side to know as they review the asset in our materials.
So look, the upshot really is that by engaging your firm, getting you in, I think early, even if there's a contemplation of exiting at some point, but getting you in, having a conversation with this client, and really talking through the concepts that a QofE with the seller, going through that analysis could shorten timeframes of a transaction, could provide much more confidence in terms of getting to a successful outcome. I mean, these things are tough to close, And unlike real estate, every one of these businesses is sort of unique, and how it's marketed and how it's represented to counterparties is unique. And having your data and information helps to facilitate the process, helps to expedite the process. And look, at the end of the day, it's all about trust, right? We talk about that all the time. And if we're providing information to the buyers that they can trust, and it's coming from a trusted resource like yourselves, that's also going to propel the success of an M&A, with regards to our clients. So no, I think that's great, and would. It's always been a pleasure working with you, and I wanted to talk to you a little bit about something that we've done in the evolution in our firm, which is that we've become effective as agents of broker dealers. So essentially, we are now officially an investment bank, and our rationale behind that was that we really felt like we wanted to elevate the level of service in terms of our credentials and what we represent to the market. We feel that we were coming a lot more in contact with what would be considered larger deals, maybe outside the boundaries of lower middle market. And so when we work with attorneys, mid-market attorneys, your firm can do virtually any size deal, but I think the sweet spot is mid-market size transactions. And when we get involved with a firm like yours, we felt that it was important for us to be able to have a full breadth of options for our clients. So Aaron mentioned earlier about the concept of a recap, or if there's some form of capital raise or a minority interest share sale, something that we can do now that we may not have been able to do in compliance as an M&A advisor without the registration with FINRA. So just wanted to let know that, and we've talked about that on top of the service that we already provide. Do you have any opinions on that in terms of how you've worked with banks in the market and the flexibility that it might afford a firm like ours?
Yeah, I mean, Andre, first of all, I think that's great, and congrats on all that. From our perspective, we work with a wide range of banks and brokers on the sell side, like I said, and doing cap raises. Obviously, regulatory compliance is important for a number of reasons, but certainly when you go out to market and you look to bring investors and buyers in, having that cannot hurt. It just can't. It gives credibility to the process and to the company that you're representing. So I think from our perspective, it's great. We work with all types of banks, large banks, regional banks, boutique investment banks, and even brokers, representing them on the sell side. Again, we don't get into the process necessarily of who we're working with and how that's going to impact the process overall. We do our work, and as long as it's a good result for our client, we're happy. So that's our goal. The folks that we work with to bring the company out to market, their job is to find the best buyer. But again, from our perspective, having that compliance is a good thing and can only help the process.
No, I appreciate that. And I think what we wanted to do is be able to collaborate on the best options for our clients. So, and just to take a step back, where we would get you involved would be if we had a conversation, right, with a prospect, right? And, the minute they say something like, we're not ready now, but we're really thinking about, selling at some point. At that point, that's when we shift into, okay, well, you can never start early enough to prepare for something like this, right? I mean, and so, there have been many cases where, we didn't want to just like slapdash get into market with something because we knew that it would most likely fail based on where the business was at that particular moment. But based on initiatives that they were doing and what they were willing to do to clean up their books and records, we would get involved with them and then, go out to market 8 months, a year later, right? But in that time frame, we're able to really build. I think the ideal for you is that when we have a conversation like that, that we make that introduction and you get in as early as possible, because then you can start to really create the framework, the aforementioned sort of framework around preparing this business and the books on this business for us to properly get to market.
Yeah, preparing the information, Andre, is key, but even before that, building the relationship with the seller. So we often like to get introduced as early on in the process as possible to work with the sellers. Even if they're 6 months, 12 months, 18 months out from potential transaction, we can work with the seller to help them get in shape, if you will, for a potential transaction. Jeff, I'm not sure if you have anything else to add there.
Yeah, no, I'd agree. Again, I mentioned the performance improvement practice a little bit earlier, but again, we've had situations, and I'm dealing with one right now, where we were brought in 2 years ago for a sell side, not in the healthcare space, but the company's books and records were such I'm just going to say they were a disaster, and so they were audited, but the reality is they had changed systems twice. Their team had changed over 3 times. And so we came in, we started our process and just quickly realized you guys just are not ready. So we brought in our CFO advisory practice to essentially help get a close process put in place so the company could close books timely, because they were taking 2 months just to close 1 month, which is not good. They put in policies to do that. Put in work with the team to essentially get the books correct under GAAP, and then we brought in our performance improvement team to identify areas of potential margin improvement. And so now 2 years later, we are starting to get to that point where we can go out to market. But if we had not done that, the company never would have been ready to go to market. So I think to Aaron's point, getting in early, yes, there is a cost to it, but that should be multiplied multiple times over when you finally get out to market and your valuation is X times higher because we've done this work. That's a rarity. I would say most of the times we get in, the books are generally clean and we work through our process pretty efficiently and get out to market, but that does happen. And so to your point, Andre, getting in there, even if you're in there and you identify something, bringing an accounting firm in, hopefully CohnReznick, but bringing an accounting firm in to do that work is beneficial.
Well, you've definitely won some, bake-offs, let's put it that way, in the past. So you're coming in and looking like the most attractive option in the market, which I can stand behind. I would say that when we get involved with a client, we like to take that position of the team lead. We're wrangling these qualified service providers, to get into the deal. And so, as we QB that, one of the outlets that's essential, could possibly be the most essential resource is what you provide to the deal. So that's where, it's important that when the client knows that when they talk to us, that we're already contemplating, okay, what's the best way to get to this successful outcome, and who do we need to bring in to get us there, right? And this is a team. This really takes a community of resources to get it going, right? And sometimes clients don't really want to hear that; they don't want to know about it. But once they see the work product, that you put out there. It also, really speaks to what their business is and the foundation of that business. And so it just seems to me like the most important investment they can make is bringing in a team like yours. We recommend they bring you in, and then you get things to a point where you feel confident about it, where we can perform a little bit about the future, and then we get involved. And then at that point, we might bring in clinical analysis, right? Which is always important. There's so many different operating metrics that we can utilize. I think you incorporate quite a bit of that as well in the work you do. Maybe you can speak to your healthcare focus at the firm, and how the work that you do might evolve into some more operational or clinical analysis on the firm, on the seller.
Yeah, Andre, and I guess just a little bit of background on our healthcare practice. We have over 100 individuals at our firm that specialize in healthcare, and we've served over 400 healthcare clients over the past couple of years. And we've worked on 100 plus healthcare transactions in FY23. But I mean, to your point, Andre, once you step outside of the scope of financial due diligence, quality of revenue, quality of earnings, as I mentioned previously, we have billing, coding, and compliance due diligence, operational reviews that will take place that will help post diligence or post transaction that will help, integrate the target, into the buyer's model, and just help them operate more efficiently. I go back to the performance improvement, that work can commence after a transaction as well to help just improve the operations of the business.
We want to make sure that the client understands that the financials are of great importance, but as we start to build our book, our information memorandum for them, we want to include the metrics that matter to buyers as well, such as for certain home health or hospice clients, there's certain penalties associated with those businesses, right? Whether it's ADRs or cap liability, and we need to know that we can look at that analysis and generate a plan, a schedule around if there is that liability associated with the business. How is it going to be paid off? Can we triangulate it? Do we know what it is? And I think that goes for there's a variety of different penalties out there in healthcare. Unfortunately, with all the healthcare laws and all that, we want to make sure that there's some quantifiable assessment of those metrics. And it's, in our experience, CohnReznick has been able to provide a deep bench of resources as we look at that other information within the business. In this environment, it just feels like buyers are being even more cautious than I've seen, over the last 10 years. Can you speak to that at all in terms of activity and what's happening in the market?
Yeah, I'll be brief with this. I think what we're hearing is obviously certainly not as busy as we were back in 2021 and 2022. Interest rates are much higher now, and obviously, to your point, cost of capital is higher. But there's still a lot of money out there, and I think for the right businesses, buyers are paying for the right business. I think the issue is some of these sellers are hesitant because the multiples have come down a bit, and they hear what their friends got 2 years ago, and they want that same multiple, and that's just not where the market is. But I think out of COVID, a lot of businesses received funds in 20 and 21, and that's drying up, and they need to go back out to market now. And so I think what we're hearing is that more businesses are coming up and out to market, and the rest of the year is expected to be generally okay. Certainly not the levels that it was 2 years ago, but not as slow as it was last year. And that's what we're seeing. I think we're definitely seeing a lot of sell side opportunities coming in. Processes are taking longer, but that's just the nature of the beast. But we're expecting a pretty, I'd say, robust second half of the year. Now, the election could obviously curtail some of that whenever that's decided, but what we're generally hearing is should be a good rest of 2024 and hopefully pick up into 2025. But Aaron, I don't know if you're hearing anything else from your discussions.
No, I echo, Jeff, what you said. And from a healthcare specific side, we have seen transactions extend both due to seller concerns and buyer concerns, just evaluating the asset and making sure they're making the best decision for them at the particular point in time with where they are.
Yeah, it's difficult when, in general, from the mean offers that the multiples have softened a bit. I will say, though, and this is, a very gratuitous plug for both of us. I will say, though, that we've when we're involved and we're able to put a package together for the market and then be there through a process. I will say that, it's been our experience that we find that outlier bid or that company that has those perfect synergies, right, where there is that accretive value, and they can give us that multiple that's 20 to 40% more than sort of the mean on the bell curve. So I will say that there's still buyer interest out there. Maybe demand has gone down a little bit. Maybe in general there's been some softening on the multiples, but healthcare is a great space to be in for us. And when we can go out there with a quality asset, and I think it's a quality asset. There's also a lot to be said about management teams and transition teams with these businesses that we represent. And when you have those two components, right, it's a good business model, and there's a management team there, and then you sort of give it that last leg of the stool, which is that you're going out there fully prepared in the market. I find like we're getting counterparties to come and give those multiples that we did see in those record years. So it's not as abundant for sure, and it's a lot slower, but it's out there. So that's a general assessment. Hopefully it gets better, and I really I love the positive perspective, and I think it very well should. Right, at some point these private equities have to refund and exit, and the strategics need to continue to gain market share. So let's hope that it does continue to get better and hopefully much better in 2025. So
the bottom line is, look, we want to work with businesses that are quality assets, and even if they need help getting their financials put together, that's okay. We want to help you and get you ready for an M&A event, whether that's a year or two from now. But happy to work with a business that might need it. So appreciate everyone's time.
Thank you very much, Jeff. Thank you, Aaron.
Thank you, guys.